Hello, I'm Dominic Hobson, co-founder of Future of Finance. My guest today is Jay Moore, founder and CEO of Hedgepool, the peer-to-peer platform for buy-side users of the FX markets. Jay, thanks for joining us.
Thanks a lot, Dominic, for having me. Pleasure to be here.
Now, as the name of the organization, Hedgepool suggests, you have a pretty specific focus on hedging activity. Can you tell us why that is?
Yeah, I mean, for anyone who knows me, I've been in the FX hedging space for about 20 years between State Street, BBH, running their overlay programs. And, some of the themes that we've seen over the years have really evolved much more towards transparency, best execution, the nature of liquidity. So when in my background is passive hedging, we saw acting on behalf of large asset managers, asset owners, sovereign wealth funds, that there was such a natural sort of liquidity pool that was sort of unreachable, if you will, in that, you have European hedgers of US dollars, you have US hedgers of euros, and in the current market structure, everyone has to really transact because of the forward nature of these swaps. They have to trade through banks where they have credit relationships and ISDAs and documentation in place. And so everything sort of funnels in through a very sort of small range of banks who are there for providing liquidity. And so there's, these elements of cost that we're trying to sort of eliminate by kind of rethinking how the swaps market is structured so that, the buy side can access liquidity amongst each other, hence the sort of peer-to-peer nature of what we do and the name Hedgepool.
Right, so you're actually trying to restructure this end of the market. In order for people watching to understand that, can you tell us a little bit about how asset managers and big funds, SWFs, even corporates are hedging risks at the moment? How are they doing it? What's the inefficiency that they are experiencing now, which you're looking to fix?
Yeah, so that's a great question. I mean, the asset manager community, for example, right? You have a large international bond fund here in the US with exposures all over the world into various securities with foreign exchange risk. You buy a European bond, you have to buy euros in order to purchase the bond. Therefore, you have the bonds return as well as the exposure to euros. In many cases, the volatility of foreign exchange is something that is preferred to be avoided. So, the mandate of these funds are to fully hedge back to US dollars using forwards. So in most cases, what you would do is you would sell a 1 or a 3 month forward, and tenor is completely bespoke, but those are the common tenors of the forward. And the P&L of the forward itself is going to offset the underlying exposure of the currency and therefore wash it out and isolate the security or the holdings. So these are funds, or like you said, sovereign wealth funds. It could be asset owners, pension plans. It could be share classes that are being distributed into other, jurisdictions that create this cross-border currency risk. And the mandated hedging programs are all doing the same thing, right? These are passive programs that either managers or the investment teams of these institutions have to basically trade on a regular, repeatable cadence to manage and maintain their hedging mandate. So the forward market or the swaps market is, for example, if you put on a 1 month forward today and it expires at the end of March, as you approach the end of March, you have to roll that position forward just to maintain it. So if you have €1 billion of exposure, you hedge out 1 billion euros against dollars, and you continuously do that, through the life of the mandate. So it becomes this very predictable but required trading pattern that, again, you have US managers and institutions who are hedging foreign currencies back to dollars. You have Europeans hedging dollars back to euros, Japan, Australia, you name it. Hedging is an incredibly universal topic. And, quite frankly, it's created the largest market in the world in FX, or I should say the largest segment of the largest market in the world in FX with the swaps. And, the most current BIS report from the Bank of International Settlements, who does a triannual report, and the last one was 2019, showed that the fastest growing part of the foreign exchange market was the swaps. And they attribute that speculatively, not based on quantitative data, but the data shows that the story shows that it's really related to the increased nature or need for hedging. So this again, this liquidity is happening at a cadence, but there's no real way for the buy side institutions to source liquidity from each other, where there's a natural passive need for offsetting positions, and therefore the banks play a very important role because of the credit nature of that relationship.
So just crudely speaking, what's going on here is that organizations are hedging the FX risk back to the base currency, assets, portfolio assets, but also share classes, which may be issued in different currencies. They want to hedge them back to the base currency of the fund. That's the area of the market you're focused on.
Yeah, that's right. I mean, really anything passive in nature, where the intent of the hedge is purely just to neutralize a risk that is part of an investment mandate, which, like you pointed out, share class hedging is a really big part of that market, as is portfolio hedging, as is corporate balance sheet hedging, as is treasuries. I mean, it's really a universal issue across the market.
Right. There's a lot going on there, including a lot of operational stuff. Can you tell us, where does your service actually start and where does it end? In other words, tell us what you're really doing to help in these areas you've very clearly defined that you're involved in.
So, yeah, I mean, one of the things maybe I'll start with is saying what we're not, right? We're not a liquidity aggregator. We're not an ECN. We're not an overlay manager, right? So we're not substituting the need for either an in-house process to manage and maintain your hedging program. There are very qualified hedging providers, whether they're institutions I've worked for in the past or the growing number of others out there, both bank and independent, or in-house. And so, because of that, those things are very well managed. Where we come in is as and when these repeatable hedging roles, the need for to maintain that hedge on an ongoing basis, where we come in is to try and align the hedgers themselves into a common pool of liquidity around a sort of scheduled liquidity event, right? Whether that's month end or quarterly IMM dates, we're trying to pull liquidity in so that they can match off with each other. So we're really kind of a discovery. We're an exchange, if you will. We're not the counterparty. We take no market risk. We're purely just allowing, through technology, passive hedgers to discover their liquidity amongst each other, which is currently sort of behind the curtain of the banks that they have trading relationships with today.
So what you're really running is a peer-to-peer, or trying to create here is a peer-to-peer market or network focused on those hedgers and their hedging events. You're not looking to be a specialist advisor. You're not looking to compete with the custodian banks. And I ask you that because you've obviously worked at a couple of custodian banks, and I back in the day that most asset managers seem very content to leave that sort of work, share class hedging, for example, and portfolio hedging to their custodian banks. So I'm wondering, given what you're trying to do here, how much has changed in the minds of these hedgers? What's going on inside the marketplace that makes it possible for you to do what you are doing? Are asset managers, corporates, pension funds more focused on this now than they used to be?
I think that there's a few things to say about that. I mean, one is that, yes, there's more hedging going on. It is a fast growing part of the industry, and therefore the volumes in the swaps market are growing very quickly. Yet it's still very fragmented. And what does fragmentation do, right? It creates layers of cost. And so, again, because of the nature of the swaps, these are forward contracts, right? So they're 1 month or 3 month or beyond. There's a credit element between a bank and the buy side. So, for example, if you're an asset manager and you're running a fund and you've got credit relationships with 5 banks on the street through ISDAs and collateral arrangements or whatever that the terms are of that relationship, you are sort of bound to those 5 banks for getting a price on your position. And at the same time, you might have a peer who's doing the exact opposite thing with their own 5 banks. And maybe there's overlap, maybe there's not. But either way, you have to call that bank or your banks and get a price. And the banks then need to manage the risk of pricing you as their counterparty. So there's a market risk transfer element of that price that's included. And so the things that go into that price are the very basics of it is that there's a credit relationship. When I do a trade with a bank, that trade goes on the bank's balance sheet. The balance sheet has an impact or has a cost. So from a capital requirement perspective, there's a cost to hold that position on a balance sheet. And therefore, that's sort of the measurable component of the fee, which is currently in the market structure today, undisclosed. It's just kind of baked in. Above that, there's the risk transfer, right? So the fact that I'm going to take a position as a bank off your hands and hope that I can either trade out of it for profit or manage myself out to at a small enough, I guess, gain that, it makes sense to do. On top of that, there's technology, right? Platform fees, the connection of how you transfer that position to me or communicate that position to me. There's compliance, traders, risk, all of these things add up into what goes into that bank's spread. And then the bank manages the risk on the other side. And one of the, so all of that cost is because of that sort of filtered relationship between the banks and the managers. Now, if you could eliminate the market risk transfer because there's somebody on the other side that's doing exactly the opposite to you, and you have this commitment to give each other that liquidity on an ongoing basis, all of those costs can disappear except for credit. So what we've done is separated liquidity from credit and said, look, if you want to participate on Hedgepool, you bring along with you your credit relationships that you have. And we've got participating banks on FX Hedgepool. We've got 6 banks already that are providing credit to our members through existing trading relationships. So they've agreed to say, look, I will accept your trades and put it on my balance sheet with no market risk, and this will be my price for doing so. And that price is now a fixed credit charge, which is, again, distilled down to only what the costs are because we've taken all the market impact or the market risk away from the banks. So now you've got this pool of liquidity where buy-side participants, passive hedgers, that's sort of how we're redefining peers. It's not so much about who you are, it's what you do. So I am a passive hedger. This is very predictable flow. This is non-toxic flow. It's necessary. Two sides put each other in and say, okay, I want to send my position, my matched position, regardless of who the other side is, which peer or other buy-side firm or firms I'm matching off against. I want to park my credit. I want to book my trade with Standard Chartered or TD or Barclays based on existing trading lines that I have and the pipes that I have in my connections operationally with those banks. So that is what we've done. And now the benefit, though, to the buy side of doing this is we talk about a number of things. And when we started this 2 years ago, we thought this was going to be all about cost savings. And that was sort of the theme. And that's what we understood to be why the buy side wanted peer-to-peer, right? We built this not because we just wanted to convince everybody that this was a better way. It's because we were listening. I mean, we could hear people in the market talking about peer-to-peer. And, there's a number of reasons why you would want that. One is, of course, cost savings. Because if you don't have 10, 15 banks and enough credit to distribute out and enough of a negotiating power to get a good price, the cost or the spread is one element of the benefit. But what we found as we went through this, especially for larger managers, most people know that Vanguard is a big participant on FX Hedgepool. They get great pricing, right? So this isn't really about getting better pricing. It's about a number of other things. And this is not just a Vanguard, this is about many of the big managers. It's that their positions are so large that they need to start trading many days ahead of their benchmark. In this case, month end, for example. So the problem of doing that is now you're substituting better pricing for tracking error against your benchmark that you're measured against. So even if you get a better price, or it's a different price than what you're being measured against, which is tracking error and volatility. So that's a cost. So this is sort of a trade-off here. And the other thing you're doing is you're breaking your trades up over many, many days so that you can go into the market softly without making a big impact by throwing too much volume into the market and hurting the price against yourself. So market impact is a big benefit, but doing that also creates a lot of need for operational risk, right? You're breaking trades into many smaller trades. You have a staff that you're paying to do this, to manage monthly rolls, that would much prefer to be doing better things with their time. So all of these things go into why the buy side really wants to do it this way, in a more automated way than having their team do this. And quickly, the sell side, we assumed when we started this that the sell side's going to hate this, right? Whenever you hear peer-to-peer in the market, you hear the sell side quickly hears disintermediation and
I was about to ask you that question, because the FX markets, however you look at it, are very bank dominated, and in terms of genuine liquidity providers, it's an oligopolistic market. There's a very small number of banks which are supplying genuine liquidity to the market. And I heard you say that you've solved the liquidity problem, but you leave the credit problem untouched. So I'm interested to hear what you have to say about how the banks are responding to the proposition that you're advancing.
Yeah, I think where we are today is very different where I thought we'd be, and in a much better place than I thought we'd be, to be honest with you, because banks are actually responding positively. And here's why. And this is not always the case in not every trade, but these monthly rolls or quarterly rolls that the buy side are doing tend, especially ones in competition, tend to be very low margin trades for the banks. If they're in competition, they're forced to be pricing at close to mid anyways, and then there's a cost for them to hedge out of that position. So in many regards, they're either pricing these and winning the deals at such low margin that it's not very valuable, but the relationship is valuable, right? And then the next trade, the outright rebalance trade, or the options trade, whatever it might be, the relationship is big enough and important enough that being there for these roles has sort of been part of the story. And so banks have not really been too upset about losing this flow, and they actually prefer to replace this flow with, or the market risk of this flow with, a fixed annuity-like service, which is credit provision. So now what they've done is they've taken a very uncertain, sometimes they win it, sometimes they don't. So the volume that they're printing their name on the tickets is varying month over month, right? And these banks are, they look at things like their rankings, right, amongst the asset managers, amongst their other clients, the corporates, the asset owners, just generally in industry. They want to see that their volumes are growing amongst their peers. And having that volatility because of the market risk and being uncertain as to where they can get out, or whether or not they can win that deal is a problem. So what we've done is said, look, you've got the balance sheet capacity. The banks that we're working with have large balance sheets. They've got great credit. So, and the asset managers are saying, this is wonderful. I can now park, unused, I can start utilizing unused credit with banks that I use primarily for specialist liquidity. A lot of Aussie flow, CAD flow that wouldn't normally see large positions in euro dollar or dollar yen or cable. So they're able to sort of, again, loosen the constraints of trying to optimize pricing with credit, right? Because those two don't always line up properly. You might run out of credit with the bank that has the best price. And so it's this constant optimization. So banks are actually finding that this is much more in line with their long-term goals of replacing uncertainty in market risk with products, services that create annuity-like revenues, which is exactly what this credit provision is.
To go back to that's interesting. Thank you. To go back to the buy side, how difficult is it for them to work with you? What do they need to give you in terms of data? What do they need to have in terms of technology? Is this like a plug and play thing, or do you need to be very large and very sophisticated and have a lot of control of your data and a lot of smart technology? Can anyone do this?
Anyone can do this. It's great because I'm glad you asked that question because when we started this, again going back to this whole disintermediation, the banks, fintech, people sort of tag fintech with disruption, and we said we don't want that label. We want actually the opposite of that, and that's not just in our business model that I just described. It's different, but we think it's a win-win for both the banks and the buy side in terms of the outcome, but also with respect to disrupting workflows. And we appreciate that there is a finite amount of time and resources that both the buy side and sell side have. And there's not a lot of airtime for entertaining thoughts of giant integration projects. So nobody really wants to sort of have to change how they're doing things. So we've deliberately designed Hedgepool to be extremely low touch, actually zero integration required for use on day one. As things evolve and grow and becomes more, a larger component of the overall liquidity of a manager or the sell side, we've then sort of moved towards integration so that the process for trade communication is automated. But day one, everyone that's on the platform now, whether fully integrated or still sort of using it in this sort of manual way, had zero integration whatsoever. Simply put, the nature of the trades that we're that we're targeting, these passive roles, quarterly or monthly, is that they're predictable, right? Tomorrow's month end. And so for the roles that are occurring tomorrow, I mean, they knew last month that they'd be rolling this. What we roll tomorrow is a very good indication of what we're going to be rolling at the end of March and at the end of April and so on and so forth, subject to things like subscriptions, redemptions, of course, and, market movements that sort of change the size of the exposures. But for the most part, if you're hedging 10 billion euros now, you'll probably be trading plus or minus 10 billion euros to, the next month, the next month, the next month. So, because of that, clients, basically members, what we call them, are simply saying, look, you don't need to know I have exactly 10 billion, 180 million, but that. It's really, I have kind of like a voice trade saying, look, I know I need to cover off around 10 billion. I'll put 10 billion into Hedgepool as my position. And as all of the other members do the same, and they reset every month, just sort of roll over into the next month, you'll see, okay, my estimated matching for these currency pairs, each a separate pool, is X. So it's either going to be 100 if you're on the smaller side, or it's going to be less than 100 if you're on the larger side. And so our job is to make sure that if you're on the larger side, we're out there curating more flow, other passive hedgers in that can actually increase that percentage and increase the coverage. And of course, that's gonna vary, and you're gonna have this sort of leapfrog effect where we start to bring in other sides, and now there's an imbalance here. So really, that's it. It's putting your interest in, and that's it. We set the dates. Again, we're creating a defined liquidity event around month end and the quarterly IMMs, and if there's interest, you put it in, and we tell you as you approach the trade date under a very scheduled cadence what your matching will be. So, for example, tomorrow is month end. The book locked yesterday, and pencils down, everything was committed, and everyone knows exactly how much matching they had and where they're going to be distributing their credit amongst the banks as of yesterday. So if someone had 10 billion and only 8 was covered, now they have the remaining 2 days before month end to cover off the additional 2 yards. But prior to that, they had a very good indication of what it was looking like in case they needed to prepare for more. So it's very much a relaxed cadence, which is the sort of beauty of the swaps market for passive hedging. And we just kind of, that's what we want to be, sort of the safe harbor place for the buy side to match up their liquidity and let the sell side get paid. Again, using that phrase, the win-win. And a good example of the why, I mean, I think back to 2020, right? When we started this, we launched in January of 2020. And we had a few members who were just sort of coming in, testing the waters, seeing how things worked. Through February, same thing, a little bit of a boost. People were a bit more comfortable. But then, of course, when March hit and the markets, the volatility came into play from COVID, and the spreads blew out from the uncertainty. And we were able to hold the line. I mean, really, because there's no market risk in what we're doing. Our costs, or our, the fees to do the service, the matching fees and the credit charges, were held stable throughout the year. So where you saw these giant spikes that, throughout the year, completely, protected from being able to match off with your peers. So, it's really not just about today's spread and can you get a better price in the market versus Hedgepool or, whatever it might be, because there is always going to be the case where a bank is willing to give you midpoint or a really aggressive price because they have a natural axe or position on the other side where they can generate, spread between the two. Here, that this is a long-term cost savings because you're eliminating all of those uncertainties through time for flow that you really are just trying to do per your mandates.
Mm-hmm. Now you're making it sound very manageable, very predictable. There's rules of thumb, orders of magnitude. But if you mentioned Vanguard, for example, Vanguard isn't going to have a lot of funds. So, and those funds are going to be suffering subscriptions and redemptions. There's quite a lot of data flowing around here. There's quite a lot of operational impact of doing all this, even if at the aggregate level, it all seems, the area where you're seeing it all seems relatively straightforward. Are you getting involved in the operational end of the business at all, or is that staying with their custodian banks or fund administrators?
Yeah, the operational side is as is. We work with overlay managers if someone decides they have an outsourced hedging program, whether it's share class hedging or portfolio hedging, and they use an outsourced provider. At the end of the day, the outsourced provider does two things. They do the management and maintenance of the hedging program with all the reporting that goes along with it and the calculations, and they execute the trades and all of the reporting that goes along with that. And in some cases, the responsibilities that go along with that. So I know that there's a natural trend in the outsourced space towards agency execution, right? Where it used to be custodians who held and fund administrators who held the data for a fund and the subscription redemption activity and all of the things that necessary, all the inputs to a hedging program were in-house. So naturally you would outsource to your custodian. And it was always a single bank principal dealing model. So you deal with the trading desk of your custodian in a captive type model. And for obvious reasons and the evolution of the market, there's been more demand for, okay, we want competitive execution. We want a panel of banks to know that we have negotiating power or you're negotiating on our behalf and not just accepting the prices of the single bank that you have available. So, outsourced providers have the ability to direct flow per the mandate. So if you're a large asset manager and asset owner, say, look, I want X bank on my panel or these 5 banks on my panel, they could very well just as well say, I'd also like you to use FX Hedgepool liquidity for my monthly flows because it gives me predictable, outcome. So, that's where we come in. We definitely are not on the sort of calculation side of the service. Again, there are really, really strong services out there, and there's no need for us to go out and try and recreate that.
But you are presumably having to report back to your clients on what you're doing, and in particular report back to them on performance. How do you do that?
So yeah, we've actually engaged with BestX as an independent TCA provider to review the executions of Hedgepool trades. Now, it's not rocket science around the TCA related to what we're doing because it's all fixed cost, right? So the way that we approach this with clients is say, to participate on FX Hedgepool, you tell us which banks you want to work with. And based on the bilateral arrangements between you and those banks, there will be a credit fee determined, not by us, because that's not our credit relationship. The bank will say, X dollars a million is what it will we'll offer the credit service for. The client agrees, and we have a hedge pool fee on top of that that's fixed in the contract, and everybody knows exactly what the cost will be off midpoint pricing. So, validating that we're doing that, of course, is important, which BestX plays that role. But they also do something really valuable for us is comparing that fixed cost to what that trade would have otherwise cost in the market, the expected cost of that trade. And this is really valuable to show that, you know, a trade does not have the same expected spread on every trade day or month end or quarterly IMM. It's very much a function of the market volatility. So one of the things that they've done well is created an independent measure of what those expected costs can be, so that we can validate, hey, look, this is the savings, in good times and bad, of using Hedgepool and avoiding all of those unnecessary costs of market trading.
Now, you've explained that your market has grown to the extent that there's more hedging activity going on now than ever before. But as you look forward, what's the growth potential you're seeing? Are there a lot of potential clients out there who just happen to be doing hedging very inefficiently or very badly at the moment, or have the wrong arrangements? Do you feel yourselves to be engaged in a rapidly growing market?
I would say, yeah, it's a rapidly growing market. There's a lot of attention being given to swaps right now because I think it's been an underserved market. You've seen a lot of innovation in the spot space over the last 10 years and longer, whether that's algos or peer-to-peer and others. And I think for a lot of reasons, the swap space has been largely left untouched. And I think the biggest reason is primarily the credit question, right? As well, do you need a prime broker to do, if you want to get, some sort of liquidity, access liquidity that is otherwise not from the bank that you have an ISDA with? And the answer until now was yes. So what we did in terms of our I think value proposition was this market structure question. We examined it, we looked at it and said, well, look, we know that these institutions are not prime broker users. They're just not. They're not hedge funds. They're not CTAs. They're large buy-side institutions that have bilateral arrangements with their banks. So by nature, they have to be connected. You can only get pricing from the banks you have ISDAs with. But we said, okay, if we kind of take the prime broker model, what is the prime broker model? The prime broker model is a centralized hub of credit to distribute or to be able to access a broad distribution of liquidity. We said, well, why don't we flip that over and say, we're going to create a centralized pool of liquidity and then allow members to access a broad distribution of credit. And by doing that is the first time that I think anyone's really been able to kind of, break that tie between credit and liquidity with the banks that they get pricing from. Mm-hmm. So for that reason, I think that there's a lot of, there's a lot of growth potential now, because we've just broken down a major wall that's prevented liquidity, passive liquidity, from actually identifying each other and being able to do anything about it.
Has regulation of the swaps market helped you or hindered you, or had no impact at all?
I wouldn't say I would say that to some regard, the regulation in the swap market and the, I think just the general attention given to swaps market and the emergence of things like central clearing, the focus on balance sheet costs that banks have, and kind of making these things a little bit more understood and measurable, has enabled this model where 5 years ago, a bank, I don't think, would have ever considered offering credit as a product. Whereas now it's something much more understood because of the regulatory environment we've been in for so long.
Just one final question, Jay. What do you say to people? It'd be very easy for your organization to fall into, oh, it's just another peer-to-peer play in the FX market. You've explained at some length that actually you're trying to do something slightly different from that. What's your elevator pitch answer to people who come to you and say, you're just a peer-to-peer network? We've seen a lot of those. What do you say to them?
Yeah, I say, we're focusing on a very different, target flow, right? The trades that we're going after. I mean, the idea of peer-to-peer is really drawn a lot of people in. And I think that there's a lot of great
well, people think of it as just intermediating the banks, don't they? That's right.
And
first
That's the
thought.
natural, right. And the, the value proposition of peer-to-peer is clear, right? I mean, being able to avoid market footprint at known costs from, market spreads and things like that. The challenge has been, and I think, people are starting to, emerge in this space, which is exciting. We want this movement to continue. But the challenge, I think, has been dependability and, this sort of predictable nature of what you do. And at the end of the day, this passive flow, we're creating a solution that enables passive flow to not just be matched as another liquidity source as part of a very robust and onerous monthly or quarterly process, but that we can become the default. Oh, that just goes to Hedgepool every month, and I know it's taken care of. So we're trying to allow not just better pricing, market impact, those benefits of peer-to-peer, but I think we're relieving the market of a lot of these operational difficulties that come along with this particular type of flow. I mean, there's very few managers or institutions that you'll speak to that look forward to their roll process. And it's just not the best part of their job. And, having somewhere dependable to sort of park it and know that it's just looked after and taken care of amongst a safe community of peers is really appealing and sustainable for the long run. So that's really the difference, I think, of what we're doing. It's the nature of this flow. And I think what our goal is to create a center of gravity, a liquidity event that will draw others to really know that this is where those roles can occur without having to worry about it.
If you had to choose between the word platform, the word exchange, and the word network, which one would you favor?
Oh, that's a good question. I would say, it is kind of an exchange. It's not in a legal sense, of course, or, framework, but it's really, it's just a place, it's a community. That's really what it is. It's more of a community. And this is one of the things that people ask me about a lot is, what about things like clearing and blockchain, and what happens when, these things evolve? And you say, look, whether you're bilaterally settling through a bank or over blockchain or directly with your peers, whatever way, you still need this sort of this community or this exchange to be able to discover each other. So that's what we want to be. We want to be that front end tool where we have where people can see where the liquidity is and match off safely. And then they can distribute their settlements however however the market or where they evolve.
Mm-hmm. You wouldn't describe that as a netting activity?
It is. Oh, it's absolutely a netting activity. And I mean, it's a good, if you think about it now, right, how do you net, right? If you're a manager, you may have hundreds of funds or dozens of funds where some are buying, some are selling euro, some are selling dollar. And you would naturally try and compress that book before you go to market, right? And so then you go to your bank and say, well, I have a bunch of buys, a bunch of sells, but I have to do a net of 5. So I'll go to my banks and ask for 5 yards of euro dollar. This is a way to say, well, I'm going to take that 5 euro dollar and see if I can net it with my peers. And then I only have a dollar, I have a yard left. Then I go to my banks. So this is a way to really, again, kind of broaden the definition of what is nettable, right? First within your institution, then within your peers, and then to the street.
Jay Moore, it's been great talking to you. Thanks for taking the time.
Thanks a lot, Dominic. It was a pleasure.
Great.